at an introduction to the statement of cash flows, and then there will be a separate pencast that you can look at in actually doing a statement of cash flows from start to finish. There are two main business goals that every business has. Number one, profitability. This means having more revenues than expenses so that we have net income instead of net loss. If the number one goal is not to make a profit, such as Meals on Wheels, their number one goal is not necessarily to make a profit, is to try to put as many meals into the hands of those who need them as possible. And so they are what's called a not-for-profit business. In accounting, we're primarily focused on accounting for the for-profit business. And if they are a for-profit business, their number one goal is profitability. They're not going to stay in business if they don't make a profit. Number two goal is liquidity. Now, sometimes we can have profitability and yet at the same time not have liquidity. So if I started a business today and I was going to mow Mrs. Smith's lawn, but she's not going to pay me until next week. Well, I'm going to debit accounts receivable and credit sales. Let's say it was $100. And I don't have time today to mow her lawn, so I get some teenager to do it, and I'm going to pay the teenager $60. So I don't know about you, but I don't know any teenagers that would do a job and say, get paid next week. Okay, they want to get paid today. So we would have to debit wages expense and credit cash for the $60. Now, if I take a look at my income statement after this first day, I have my revenues minus my expenses. My revenues is the sales of $100 minus my expenses, which is wages expense of $60. And so I have net income of $40. My very first day of business, I have achieved the number one goal, which is profitability. Woohoo! However, I don't have enough cash to pay my bills. I can't pay the kid. He's not going to work. And so already on the first day of business, I'm going bankrupt. And this happens to very large businesses, the same kind of thing, where they might have profitability, but they don't necessarily have liquidity. The statement of cash flows is going to show us how the cash is received. How is it coming in? Where is it coming in from? And how are we spending the cash? And what does our cash system look like? You know, are we having enough liquidity, etc.? There are, besides the two goals, there's three activities that every business engages in. The operating activity, investing activities, and financing activities. Now, the operating activities are the day-to-day operations, all the activities that revolve around those day-to-day operations. The investing activities are activities of buying and selling long-term assets. So if the company needs to buy cookie ovens for the, making the cookies that we're going to sell, okay, the cookie ovens is a long-term asset. And whether we're buying the cookie ovens or it's an old cookie oven and we're going to sell it to some other company now, whatever it is, if we're dealing with the long-term assets, that's an investing activity. Financing activity is issuing and redeeming notes, notes payable, and issuing new corporate stock. If we're a corporation, we can issue stock and get financing that way, we don't have to pay it back. If we issue notes or bonds, then of course we have to pay those back. Okay, redeeming means paying back. So whether I'm issuing a new note, which means I'm signing on the dotted line that says I promise to pay, okay, or I'm redeeming the note, which means I'm paying it back. Or if I'm issuing new corporate stock, all of those are financing activities. So every business engages in these three types of activities to some level or another. Now, we can easily tell if you think about the kinds of accounts that you're dealing with, you can easily tell what kind of activity it is. So an operating activity are those activities that deal with current assets and current liabilities, because those are the things typically that are dealing with the day-to-day operations. The long-term assets, whether we're buying or selling them, we're dealing with investing activities. And the long-term liabilities, like notes or bonds payable, and the owner's equity section is dealing with financing. So if you're looking at a particular transaction and you know what accounts are involved, then you would know whether it's an operating, investing, or financing activity just by knowing that. We want to show the flows of cash, but our books are in the accrual method. And we are using the matching principle. Remember, we're showing the revenues, we're recording revenues when they're earned. When we either did the job or shipped the product, that's when we earned the money. So that's when we're showing it as a revenue. We're crediting sales at that point, okay? If we didn't receive the cash, then we would debit accounts receivable. Then later, when we actually receive the cash, we would debit cash and credit accounts receivable. But the sales, the revenue, is recorded when we earn it. Likewise, with the expenses, they're recorded when they're incurred, meaning when we get the bill. So when we get the electric bill, we're going to debit electricity or utilities expense, and we're going to credit accounts payable, because we're not going to pay that bill that very day. So later, a month from now, when we actually pay the bill, we'll debit accounts payable and credit cash. But the expense, the utilities expense, was debited when we received the bill, when we incurred that expense. So that's what the matching principle is all about. And GAAP, of course, requires us to use the matching principle, the accrual basis of accounting, okay? But the accrual basis of accounting doesn't show the flows of cash so well. Now, the cash basis of accounting, that records revenue when we actually receive the cash. So if we mow Mrs. Smith's lawn today, but she's not going to give us cash till next week when it's the next month, then we would wait until we got the cash. Even though we mowed it today, we would wait till we got the cash. We would debit cash and credit sales. Okay? Same thing with the utilities bill. We wouldn't record anything when we got the bill. We would wait till we actually paid the bill, and then we would debit utilities expense and credit cash. That's the cash basis of accounting. And it doesn't use the matching principle, and so it is not acceptable for GAAP. But of course, only the public companies are required by the Securities and Exchange Commission, the SEC, is over all the public companies, and they require that the public companies must use GAAP. So the public companies cannot use this cash basis of accounting. Okay? And even if you're a private company and you don't have to therefore follow GAAP because you're not under the thumb of the SEC, Okay, if you're a private company, you can do it how you want. But the minute you go to get bank financing, which most decent sized companies have some bank financing, the bank's going to tell you, oh, you must follow GAAP. So even if you don't have to follow it by law, you're going to have to follow it because of financing reasons. So there are only a small number of cash basis businesses, and they're usually very small. They don't have a bunch of bank financing, and so and the IRS does allow you to use cash basis of accounting. However, like I say, most of the companies that we're going to account for are going to use GAAP, and so they don't have this cash basis accounting. If you have the cash basis of accounting, then everything is cool as far as the statement of cash flows. You have all the records showing all when the cash is coming in, who it's coming in for, how it's spent, when it's going out. So it's all very easy. Because we're doing things with the accrual basis, we have to use what's known as the indirect method to do our statement of cash flows. If we were on the cash basis, we could use the direct method. It's all nice and easy. The indirect method starts with net income, which of course comes off this income statement, and the income statement was made on the accrual basis. Okay, so that net income now needs to be adjusted back and forth till we get it down to how much cash would have come in from this net income. The indirect method separates out the cash flows by the three business activities: the operating activities, the investing activities, and the financing activities, like we talked about earlier. The final outcome should match the cash account that's on the balance sheet. Okay, so let's start with the operating activities. The operating activities are divided into two parts: the non-cash adjustments and the changes in current assets and current liabilities. Those are the two main parts or sections of the operating activity section. Now, you can put this all in one, but it's easier if you keep them separate. Now, the non-cash adjustments include the following things. If you had any losses from the sale of long-term assets from the income statement, we need to wash those losses out, because the loss itself that's shown on an income statement has nothing to do with the cash. Okay, and so we need to wash that out of the net income. So we need to add it. We need to take the net income, and then we need to add whatever losses were on there, because we want to wash that effect out. That loss was subtracted to get down to net income, so we need to add it back to wash it out. If we had any gains from the sale of long-term assets, again, gains and losses are based on a formula where we take the amount received minus the book value, and that gives us the gain or loss. And so that gain or loss is going on the income statement. If it's a gain, it's going to get added. If it's a loss, it's going to get subtracted. Okay, so the gain and the loss is not the cash itself, so we need to get it out of there. We need to undo it. So since the gain was added to get to net income, now we need to subtract it back off. Depreciation expense is, as we know, allocating the cost of assets that we purchased at some past time, and we're allocating those costs over the useful life. Well, that depreciation expense has absolutely zero to do with cash. So we need to wipe it out. Now, we subtracted depreciation to get down to net income on the income statement. So now, to wipe out the effect of it, we need to add it back. Amortization expense is like depreciation. It is the cost being allocated over the useful life of intangible assets, things like patents and trademarks and other various intangible assets. And so it acts just like depreciation. If the company has amortization expense, it's subtracted on the income statement to get down to net income. It has nothing to do with cash, so we want to wipe it out, so we need to add it back. So when we're doing this non-cash adjustment section, we're going to look and see if we have, so what we're trying to do is to wipe out the effect of things that don't have anything to do with cash off of the income statement. So anything that was subtracted on the income statement, we're going to add it back. Everything that was added on the income statement, we're going to subtract it back. Okay? The next thing we have is the changes in current assets and current liabilities. Remember, those are the operating activities things. So we're looking at how those things have changed. And we will be just looking at the beginning amounts and the ending amounts and the total that. Okay, when we're taking a look at the operating activities, an increase in a current asset causes a decrease in a cash flow. So in other words, if I have more accounts receivable than I did at the beginning of the year, it's because more people gave us cash. Okay. If I have, or rather that less people gave us cash, I'm sorry, if I have more accounts receivable, that means more people have purchased things from us on account, and less people have paid us the money they owe us. And so the cash flow itself has gone down, even though accounts receivable went up. And then just the opposite. If I have a decrease in accounts receivable, that means that I must have had more customers give me the cash. And so a decrease in a current asset like accounts receivable causes an increase in a cash flow. So in other words, current assets have opposite effect on cash flow. So as we're looking at the current assets and we see accounts receivable has gone up over the year, we're going to say, oh, that has an opposite effect on cash flow. Cash flow must have gone down over the year by that same amount. And I look at a different current asset, oh, supplies went down over the year, well, then cash flow went up as an opposite effect of that. When we take a look at the liabilities, the current liabilities, let's say accounts payable. If I have an increase in accounts payable, that means I bought more stuff on account and I haven't paid as much of my cash out. So an increase in a current liability such as accounts payable means that I have more cash. So there's an increase in my cash flow. If a current liability goes down, like accounts payable has gone down over the year, that means I must have paid more cash out to my vendors. Okay, and therefore my cash flow went down along with the balance of accounts payable. So in other words, the current liabilities have a same side effect on cash flow. If the current liability goes up, so does the cash flow. Current liability goes down, so does the cash flow. Okay? Current assets have opposite effect. current liabilities have a same side effect. So we're going to list any increases and decreases in the current assets. We're going to show decreases as an addition and increases as a subtraction. Then we'll list any increases and decreases of current liabilities, and we'll show the increases as an addition and the decreases as a subtraction. To finish the operating section, once we have all those non-cash adjustments done and we have all those additions and subtractions of the current assets and current liabilities done, we take our net income, which is what we started with, we add and subtract all those adjustments from the operating section, and we'll get down to a number. If that number is a positive number, then we're going to label it as cash provided by operating activities. If it's a negative number, we're going to say cash used by operating activities. Now, once we leave the operating activity section, we're going to take a look at the investing and financing activities section. Remember, the investing activities are those things that dealt with long-term assets. Financing activities deal with long-term liabilities and owner's equity accounts. Okay? To be able to do the statement of cash flows, we can't just look at how much it changed for the year like we did with the current assets and current liabilities. We have to actually analyze all those accounts. Every long-term asset, every long-term liability, every owner's equity account has to be analyzed. And we have to figure out what made it go up and what made it go down. I'm not just looking at the overall change over the year in those. I have to look at every single thing that made that account go up or down. Okay? We need to make, therefore, analyzing tables for each account to show what made it go up and what made it go down. Okay? And then we'll use those things as our items that are going to go on the statement of cash flows. When I add and subtract the cash flows from the operating activities, plus or minus the cash flows from the investing activities, plus or minus the cash flows from the financing activities, those three activities each have their own cash flow number. When I add and subtract all those together, I get something called change in cash. Then I take the beginning cash from the balance sheet and I add that to the change in cash, and that gives me the ending cash. Okay? And that ending cash needs to match the balance sheet ending cash. Finally, at the bottom, I'm going to have if there's any long-term assets were traded for long-term liabilities that didn't have any cash involved, then those trades will be noted on the bottom of my statement of cash flows. They will not be part of the investing and financing activities. So in other words, if I go to the vendor and I say, I want this asset, and here I will sign a note payable for it in exchange. Okay, no cash was involved, and that would not be on the body of my statement of cash flows. That would just be noted on the bottom. If, however, I go to a bank and I borrow money, I borrow the cash, okay, then I take the cash and then I go to the vendor and I buy the asset and I give the vendor the cash. Okay, now it's still the same thing. I still sign a note payable with the bank, but cash was involved in that transaction. And so I would have an increase, in a long-term asset where I paid cash out for it. And I would also have an increase